didn't change rates, but the market's not too perturbed about that. Let's see, the market still hopes, of course, that going forward there will be rate cuts. And of course, this morning, Asian markets are doing well. And for our market, we have a positive deal, that Apollo deal with HDFC. That should have some positive impact, not just for Apollo hospitals itself, but perhaps for the market itself. We'll find out. And of course, the market's been taking support at 50-day moving average for the last couple of days. This is Badar, and of course, with me, Sonia and Surbhi. Good morning.
Hi, good morning, Anuj. Hi, good morning, Surbhi. Well, yes, I mean, the Fed has held rates steady. I mean, there are no surprises there, and perhaps a rate cut in July. Maybe, on the flip side, some concerns for our market would be perhaps FII and DII selling that we had. Both FIs, DIIs sold in the market. But Anuj, another positive point that perhaps the market could focus on today is the fact that the Met Department last evening came out with some comments that saying that no, the monsoons are not a worry. Remember, over the last couple of days, it was a bit of a worry that, monsoons may be delayed, etc. They said normal monsoons in July and August and no concerns on water reservoirs, etc. So that's another positive data point. But on this deal itself, the HDFC Apollo deal, do you think it's just a sentiment positive that this that we would see today, or would the market extrapolate it to some more positives?
Look, the issue is it's a big positive, and why it is a big positive is that while we knew that something like this would happen, the market hasn't priced that in. The Apollo stock itself yesterday was at the low point, not at the high point. So that way, why is this important? What's the biggest worry for our market over the last two months, especially in the broader market, is the leverage and the promoter pledges. So here is the point, and that's something which everyone should recognize. By the way, Apollo is almost at lifetime high. Today, it should hit lifetime high. But that is the issue. You have one set of companies where promoter pledge was just an overhang, and where the underlying business is very strong. For last 2 quarters, they've been reporting great numbers, and the market believes going forward also the numbers would be strong. That's one set of stocks where even if promoter holding is pledged, but you're hopeful of some kind of deal to sort of sort that out, those would be great opportunities. You don't want to extrapolate this though, because every deal is different, and this is a deal in which both the buyer and seller agreed at a price, so that's why that deal has happened. Perhaps new high for Apollo hospitals. Anyway, it's almost at new high, but beyond that, don't want to extrapolate that. It's just that there should be a bit of a sentiment uptick today because of this deal.
And there are hardly such deals that have played out, right, over the past
exactly.
6 to 12 months.
Everything has got stuck. So this one at least has played out. So that's why it's positive.
But that's obviously positive for Apollo, as you described, Anuj. But I also want to talk about the rest of the market. As you mentioned, Asia is positive right now. Let's pull up the SGX Nifty. We are getting a 20-30 point leg up, and most of the markets are up around 1%. But the question is that, how long will the global cheer itself last? Because now when the Fed event is out of the way, you get back to the reality of, okay, let's see what happens at the G20, trade tensions, etc. And even if the global euphoria plays out, our market has had its own set of problems, right? The way we were breaking down even yesterday. So then, how do you look at trade today?
Yeah, jury's out on whether we broke down yesterday or actually in last half an hour stage, just smart recovery. I think the simple thing is we yesterday had an outside day. What's an outside day? Where the high and low both are beyond previous day's range. The high was higher than the previous day's high, and low was lower than previous day's low. Normally after that you have a bit of a sideways day. Also today's the weekly options expiry. So perhaps today the market plays in a bit of a range where both the highs and lows do get defended. But for last 2 days of defending 50-day moving average, and I think from being net net long, this market is now net short and is oversold. So again, you'll need something to scare the bear. Like we saw yesterday, even a 150 point gap up was not enough. Even that was sold into. So the broader texture of this market is still sell on rally unless proven otherwise. For it to change the texture, you'll have to go past 11,850, which was the erstwhile support. Now it's the resistance. You'll have to go past 11,850, trade above that, and then only can you get into some kind of a different terrain. Like I said, opportunity and adversity in the mid caps could be the theme. Like a lot of people already played out with Apollo hospitals. So you need to perhaps identify more such stocks which have fallen only because of the mid cap mayhem. Also, one more point: while the Nifty is at 11,690 or 700, the broader market now represents a Nifty less than 10,000. If you go through the list of stocks making 52-week lows compared to 52-week highs, I think that list is humongous. That list now runs into pages. Stocks at 52-week low, and I'm talking about good quality B group stocks. That list is now, almost reaching the highest that we had last year. If you see the stocks hitting lower circuit, compare them to stocks hitting upper circuit. So the broader market is in a mess, but let's see if at some point there's a recovery, because that's the part of the market we have to be focused on.
So, the broader market is in a mess. This is a sell-on rally market. We've seen banks under a lot of pressure. Today, there's additional negative news on IT stocks. The possibility of US mulling capping the H-1B visas. You think that's the next pocket that could be under pressure?
I don't know. Let's see. I think IT should react a bit look, you can't expect US to also not, retaliate. If you put tariffs. So obviously, a lot of this is rhetoric. Also, with IT companies, the only thing I would say is that this has been an overhang for so many years.
Long,
And the fact is that for American companies, you just can't do without Indian IT companies. So that I think...
it could be a sentiment at worst.
But there should be a bit of sentiment hit today.
But the question is, Anuj, whether that restricts itself to being just an IT sentiment issue, or does it become a market sentiment overhang? Because, if you're really getting into some sort of a major war with Uncle Sam, then will that be a market event?
No, I don't think. That's not the market is right now.
I think the market has bigger issues to worry about, like debt defaults and, leverage, etc. Just look at the broader markets and you'll have several examples to prove that point. But let's do one thing. Let's kickstart the show and tell you what our wise experts have to say as we head into trade this morning. Johanna Chua of Citi says changes to the policy statement, lowering of the dot plot projections, and comments by the Fed Chair Powell at the press conference have more than corroborated market expectations of aggressive easing by the Fed. Fed fund futures are suggestive of 75 basis points of cuts this year, with about 32 basis points of cuts priced in for the July FOMC meeting. The 10-year US Treasury yield is flirting with 2%, US equities have strengthened, and the dollar has weakened. With the Fed opening doors for easing down the road, the receiving interest is likely to get emboldened further. Yields are likely to drift lower across the board in Asia.
Let's get you some money market views as well. Mohan Shenoy of Kotak Mahindra Bank says, as expected, the US FOMC has kept rates unchanged, and the accompanying statement suggests a rate cut in the subsequent meeting. Impact on dollar was limited, as ECB, Bank of Japan and most other central banks have taken a similar dovish stance. Rupee continues to be boxed in a tight range and is likely to trade between 69.5 to 69.80.
Okay, and on the bond market, Mohan Shenoy says it is expected to remain supported as globally bond yields have seen a decline. Gilt rally was triggered by the OMO announcement by the RBI but was interrupted by higher crude prices and profit booking. Next trigger for the market will be the union budget early next month. The 10-year bond is expected to trade in a range of 6.8 to 6.86% for the day.
So we don't have a rate hike or rate cut rather from the Fed just yet, but promises that cuts will come in the near term. Let's go across to Nigel for the world view.
Well, that's right. The US markets, they ended in the red. Remember, for this month itself, they're up between 6.5% to around 7%. There's that hope that they're going to go ahead and ease interest rates out there. The broad highlights for overnight was that, in fact, they didn't change interest rates, but that was on expected lines. Though they've dropped the word patient, that, in fact, was read that they're open to helping the economy sustain. They've opened the door for near-term loosening in terms of policy as well, and that's why the markets did end higher. The real barometer is the dollar index. It was at around 97.7 odd. That's cooled down to sub 97 mark, telling you that out there they definitely believe that there is some easing that's coming about. Even the bond yields cooled down to below that 2% odd. That's the first time since November 2016 we did see the bond yield come to that level. Banking stocks, they did see some selling pressure. All the frontliners ending with a cut of around 0.7% to around 1%. But you had a big weight on the Dow. That's United Health. That stock was one of the biggest gainers, ending with a gain of around 2%. And that's why we did see the Dow ending in the green overnight. Well, moving on to the European markets, they ended mixed in yesterday's trading session. The CAC was a relative outperformer, while the FTSE did see some selling because you had some of those basic resources that were under some pressure overnight. But the big winner really overnight has been gold. That, in fact, has hit the highest levels we've seen in the last 5 years, or a big run being seen out there. And this morning, the Asian markets, it's green on the screen. Most of those markets trading with good green. That suggests that the SGX Nifty will open up with a gain of around 35 to around 40 points out. Back to you guys.
All right, thanks, Nigel, for that. It will open up in the green, but will it stay there through the course of the day? We've been seeing a lot of sell-on rally moves come in the last couple of days. Perhaps today could be no different. But let's see. Let's focus on the big global story this morning. The US Fed Reserve has left its lending rates unchanged at 2.2 to 2.5%, but has indicated that there could be rate cuts coming from the next policy onwards. Here are Jerome Powell, the chairman of the US Fed Reserve, his views on US growth and inflation.
My colleagues and I have one overarching goal: to sustain the economic expansion with a strong job market and stable prices for the benefit of the American people. At the FOMC meeting that concluded today, we maintained our policy interest rate, but made some significant changes to our statement. Since the beginning of the year, we have judged that our current policy stance was broadly appropriate and that we should be patient in assessing the need for any changes. In light of increased uncertainties and muted inflation pressures, we now emphasize that the committee will closely monitor the implications of incoming information for the economic outlook and will act as appropriate to sustain the expansion with a strong labor market and inflation near its 2% objective. The economy has performed reasonably well, with solid fundamentals supporting continued growth and strong employment. Inflation has been running somewhat below our objective, but we've expected it to pick up, supported by solid growth and a strong job market. Along with this favorable picture, we've been mindful of some ongoing cross-currents, including trade developments and concerns about global growth.
Okay, we have two guests joining us now. Adrian Mowat is with us, emerging equity market strategist, and Jeffrey Dennis as well now joins us. Good morning, gentlemen. Adrian, your thoughts first. Right now we're seeing emerging markets calm. They've reacted rather positively to the commentary from Fed. Your thoughts on whether this rally could extend?
Actually, I was kind of surprised the market didn't sell off today because we had that big move yesterday on the Fed expectation. And I think the chance of the Fed cutting rates are actually incredibly low despite what the bond market is predicting. So if you look at the story here, you've got President Trump in Florida claiming the best ever economy that the US has experienced, at the same time putting political pressure on the Fed to cut rates. You know, the US economy is strong. It is generating jobs. The consumer data remains very robust. You did see a deterioration in the business sentiment data, which I think was primarily focused on the trade dispute with China, plus Trump threatening to put 5% tariff on goods coming in from Mexico. So I think the case for the Fed cutting rates is incredibly weak. I would argue perhaps the move on the China market was more to do with what's being said about the Osaka meeting and Xi and Trump getting together, and some hope that the tension around the trade dispute, which escalated dramatically in May, might ease somewhat. So I think if this is about the Fed, then markets probably shouldn't continue to rally. If it's about the trade dispute, then I think the news is perhaps moving in the right direction.
Jeff Dennis is also here with us. Jeff, you know, that's the big story, right? Although we are talking about the Fed right now, the overarching theme is the trade war and how it's been stifling growth across the globe. Do you reckon that emerging markets could be headed for some deeper cuts through the course of 2019?
My sense is that the U.S. economy is perhaps a little weaker than Adrian is indicating. I still think that he's right in that I think the case for a rate cut now is very weak indeed. I mean, there's no reason for even an insurance rate cut, as it seems to be called these days. So the economy is reasonably okay at the moment. I think it will weaken going forward. Inflation is low, and obviously the bond yields below 10%, below 2% are telling you something about what the market thinks about where the economy is headed. My view has always been that if we get a slowdown in growth in the U.S., and we do get some Fed activity on the back of that, some rate cuts eventually, emerging markets should probably do relatively well, because the logical follow-on from that is a weaker dollar. although the dollar's reasonably stable today, which is interesting. If, however, eventually, as I think there's a good chance we will, maybe sometime next year, head into a more serious economic situation, the U.S. possible downturn, well, then the flight to quality that you'll get will hurt emerging markets generally. So I think we've got to watch global growth, soft global growth, with low bond yields and a bit of Fed cutting and possibly a weaker dollar. That's a really, really great environment for the emerging markets, as traditionally is the case historically.
Adrian, good morning. Question to you. Even if we do start getting more rate cuts from global central banks, how much of that money is going to flow into emerging markets, specifically a market like India? Because we've also had our own set of woes to deal with back home, whether it's slowdown, whether it's a lot of leverage within corporate groups, defaults, etc. So can we still hope to get in more foreign funds?
Yeah, I think we put too much emphasis on global central banks' activities. I mean, we've been in a post-global financial crisis period of QE, zero interest rates for well over a decade now. And we've seen extreme volatility in emerging market equity performance. And ultimately, it's to do with the domestic dynamics. Now, India has had superior, more consistent domestic dynamics than the other big emerging markets and has tended to have relatively consistent flows and investors focusing on relatively expensive but high-quality, consistent growth companies. I don't see that changing. I don't think that changes post the election results. What will influence India more is perhaps what's happening with the other emerging markets. So if we get a reduction in trade tension, then you will get a reallocation of capital towards North Asia. As events pan out in Brazil with regards to economic restructuring there, that could attract capital away from India. So I rather see India as the sort of constant, very consistent performer, and around it you've got more volatility around the domestic fundamentals in some of the major emerging markets.
Okay, Jeffrey, your thoughts on a market like India from here on? We'll have the union budget now in less than 2 weeks from now. There's some concerns about what may happen with the fiscal deficit number. Also, some concerns about perhaps long-term capital gains tax. Do you think the Indian market will have some headwinds going forward, or you think it will be able to climb the wall of worries?
No, I think it will be able to climb the wall of worry. Obviously, there are concerns about the budget deficit. They've been there for quite some time, and I think they will probably remain, because it's hard to imagine you're going to get sufficient fiscal adjustment that you actually see the budget deficit coming down. But I think Adrian's dead right that India will continue to be a solid performer, maybe a low beta performer in a very volatile emerging market environment. I mean, if you get an easing of trade tensions, that's going to benefit some of these other economies and other markets over India. Bear in mind, as I've often argued, India has very little in the way of economic links with China, with trade links with China. So if all of this is going to blow up into a major trade war with China, which I still think is probably unlikely, although it's gone a fair distance already, I think India is a good defensive play against that background, because we have to remember that although growth has been disappointing, and there's a feeling that perhaps the central bank, the RBI, was encouraged to cut interest rates because of the political situation. You've still got low inflation, good monetary policy, decent growth, and that will stand India in pretty good stead, especially in an environment where global volatility increases with an increase in the trade war. So once again, I think it remains a pretty good low beta defensive play, as opposed to necessarily being a market that's going to be a big outperformer if emerging markets do well.
Actually, that's interesting because, you know, Adrian, Jeffrey, you guys have a bird's eye view, right? You're looking at India relative to other markets. I mean, sitting here in Mumbai, we are dealing with the local debt issues, leverage issues every day. So we really don't get a broader perspective. But one final word from your end, Adrian, since you are optimistic on India, would you be putting money to work right now? I mean, we have about less than 15 days for the budget. Or will you wait for the outcome of the budget before taking that call?
I wait for the outcome of the budget. The markets had a very good move relative to other emerging markets because of the election results. I think you mentioned these issues such as debt, the problems with the NBFCs, with the PSU banks, etc. To some extent, that actually perversely benefits the index because the private sector banks that win market share because of the problems here are a large part of the benchmark. And so India's stock exchange index is relatively flattering versus the macro fundamentals. And that's all to do with the fact that the problems in the banking system benefit the private sector banks.
Okay, well, gentlemen, we will leave it at that. Thank you for joining us. The Fed, statement has come and gone. No impact on emerging markets. In fact, both Jeff and Adrian believe that relative to peers, India stands out as a good pick. But let's take a quick break on that note. On the